Currently, American homeowners have more equity than ever before. I'm talking record-breaking equity. And now it's been announced that Freddie Mac wants to help homeowners tap into that equity. Is this a good idea? Should Freddie Mac get involved? Just what is home equity and what is home equity lending? Tune in and you'll find out. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC.
John Coleman.
Yo, what's poppin'?
I love saying, and my main man.
Yeah, JC.
Yes. I say it's been a while.
It's been a week.
We have gone on this string of badass after badass after badass.
Bangers. It's like one of those compilation albums.
Guest host. Yeah. Yes. Yeah. What do you call that
It's
album?
like one of the compilation albums of like the greatest hits of all the greatest people.
Yes. It's like, hey, JC, go ahead and take a side because we're going to bring in Pitbull on this one. We got Mariah Carey on this one.
I will do it forever. I look forward to just being
the people miss you, John.
They don't give a shit.
I'm getting
about
text
that.
messages.
They do not get
emails, LinkedIn. They're like, yo, where's JC?
I canceled my gym membership.
I think I heard that in the last one.
I did, but now I ran my first K outdoors yesterday.
Just 1K?
No, 5K.
Okay, good for you. Did you time it?
No,
I'm curious.
It's like, 36 minutes. I had to slow down because
the heat got you, right?
It's difficult because you don't realize on a treadmill, obviously it's flat, but there's like undulations in the road. So like it's like 5% incline down, and I have to avoid cars and fucking cows chasing me and shit. So
that's a big word, undulation.
Undulation.
That's a really big word. Can you spell it?
Undulation.
Hey, I would have started with an A. So the fact that it starts with a U, we're good to go.
That was one of the words that I just ulterior
motive.
Yeah, I just found out that starts with a U.
Yeah, I was probably today years old too.
I
Spelling
thought it was
never my jam.
I thought it was like ulterior, like
alternative.
Yeah, it's alter, like ULTER.
Well, there we go.
Just piqued interest. I bet there's so many. I bet 94% of the American populace think piqued my interest is spelled like peak of a mountain.
No, I would say PEK, like I'm peeking into something.
Yeah, PEAK. You would think, but no, PIQU. Go France.
Oh,
you didn't know that either?
No. Wow. No, listen. I joke about this because I've always been the world's worst speller.
Yeah, me too.
I'm pretty good with punctuation. I'm good with grammar, sentence structure for the most part. But spelling was never my jam. So I used to joke with people, hey, look, I married an English teacher so that I would never have to learn to spell.
Right.
Yes.
Peaked is PIQUED.
And I definitely, as the audience knows from tuning in, I will mispronounce a word and then I will double down and own the fact that I mispronounced it, but I'm not going to change because in my mind, that's how that word sounds.
Good.
But nonetheless, home equity lending. We're going to just rip the Band-Aid off. We're going to jump straight into it, okay? Home equity lending. For mortgage professionals, this should not be new news to you. Now, to our real estate professionals that tune into the show and all of the homeowners and future home buyers that tune into the show, this may be new news. Like understanding what is home equity lending, why would people do it, what are the reasons for tapping into your equity, is it bad, is it good? Like that's what we're going to unpack today. And then recently, and this is going to be more for the mortgage professionals, like Freddie Mac, for the first time ever, right, so we have Fannie Mae, we have Freddie Mac, their brother, their sister.
Quasi-government agencies that were instilled by the Dodd-Frank Act.
You're almost there, John.
Damn it!
They are quasi-government. They are quasi-government agencies. We call them the GSEs, the government-sponsored entities. They were incorporated way before Dodd-Frank. What happened after Dodd-Frank is they went into conservatorship.
That's right.
And then Dodd-Frank created the FHFA, and now the FHFA is basically the parent. Right? Of Fannie and Freddie. Right. Fannie and Freddie are brother, sister, okay? And Fannie is by far the older, bigger, bossier. Freddie is the more fun, younger.
Let's go hang out till midnight.
Yeah. Yep, that's very much. And for my executives that tune into the show, you know what I'm talking about. Everyone else is like, what is Dio talking about? I'm like, look, we'll leave it there. We love both Fannie and we love both Freddie. But they definitely have their personalities and they have their strengths and they have their weaknesses, right? Just like all of us do. Mm-hmm. So nonetheless, never before in my 2 decades of mortgage lending do I ever remember Fannie and Freddie, these government-sponsored entities, raising their hand and saying, hey, we want to help make equity lending more available. Because that's what Fannie and Freddie do. They are backstops. They're liquidity facilities to lenders that allow banks and lenders to go out there and underwrite and fund loans, knowing that there's someone who's going to purchase these loans from us. That's what a liquidity facility does. But those are always loans that were first mortgages. They were your traditional 15, 20, 30-year fixed mortgages, right? That type of loan. And a home equity loan was always also known as a second mortgage. And second meaning it went into the second lien position, meaning if you, John Coleman, ever foreclosed, the first person who got paid when that home sold was the first lender, the first lien, and then any money left over could go towards any other lien holders. A lien holder would be a second mortgage. So second mortgages were always deemed to be a little bit riskier to lenders because they're not in the first lien position. Second mortgages were typically something someone would take out after they had owned the home for 5, 10, 20 years because their home had gained equity. And they normally, and by the way, equity is your home going up in value. You bought the home for $200, it's now worth $400. Theoretically, you have $200,000 of equity that you've gained from purchasing the home, plus you have equity that you have earned because you paid down your loan. Okay, so but like just in most basic principles, you bought the home 10 years ago for $200. Today it's worth $400. You only owe $150 on it on your mortgage, so you have $250,000 of equity. There's a bank out there, there's a credit union out there, there's a lender out there that will give you not all of the $250, but they'll give you some of it, maybe $50, maybe $75, maybe $200, based on whether or not you qualify. And you qualify for home equity loans the same exact way you would qualify for any other type of loan or mortgage. They're going to want to check your payment history, check your credit, make sure you have an opportunity to pay them back. But your terms are typically not as favorable because it's a riskier loan. You're in the second lien position. So that would make a bank, credit union, or a lender not want to offer you a 30-year fixed term. Maybe it's only a 10 or 20-year loan, and maybe your interest rate is not fixed. Maybe your interest rate is variable based on what the prime rate's going to do. So over the past 2 years, if you had a home equity loan that was tied to prime, it sucked for you because you saw your interest rate go up like 10, 12 times, which meant your payment went up 10, 12 times over the past 2 years. If you're in 2024, 2025, and you're taking out a home equity line that's attached to prime, well, that may be a good idea because there's a good chance that your rate's going to go down at least once, if not twice this year, and maybe 3 or 4 times next year, and then another 2 or 3 times the year after. But please know that loan itself, not only do you have a variable rate, but it's probably only a 10 or 20-year loan. So that's just in general home equity lending. But let me get back to Freddie Mac. Freddie steps up to the plate and they say, hey, we want a piece of the action. We want to get in on this game. Now, it's a pilot program. And by pilot program, I'm going to throw out some numbers here. And please, if you want to go fact check me, but I'm going off in memory. But I think the pilot program is where Freddie is only going to purchase like $2.5 billion worth of home equity lines of credit or home equity loans. By the way, you'll hear people call these things HELOCs. You'll have people call them HE-loans. Okay, just like we call ourselves TLOP, which stands for or stood for the Loan Officer Podcast. A HELOC stands for a home equity line of credit. A HE-loan is a home equity loan. The difference between a line of credit and a loan, lines of credit, just like a credit card, you can rack it up to the full balance of what is the limit is, and then you can pay it down. And then you can rack it back up and you can pay it down, right? It works very much like a credit card would. It's attached to your home. That's the collateral. A HE-loan works like an auto loan, works like a student loan, works like your mortgage does, where the payment is principal and interest, and you are set with a schedule to pay it off by this date, paying this interest rate for this many months. So a HE-loan is something that we call a closed-end mortgage. Also, they call them closed-end seconds. When it's closed-end, just means that it's going to be a principal and interest payment, at which point you will eventually pay it off. A line of credit works just like a credit card, right? You could owe $0 and then go out and charge $20,000 to your home equity line of credit, then pay it down to 10, charge it back up to 30, like whatever your limit is, that's what you can do. Okay. So Freddie gets in the game, but they're only going to do $2.5 billion. And I think the market right now for home equity lending is something ridiculous. And this is where I'm going to butcher the number. It's like somewhere between 46 billion and maybe 146 billion. Like, just know it's a huge number that's way larger than 2.5 billion. But the fact that Freddie's getting into it, it has certain people in the industry, in the government, citizens of our country that are like, that's bullshit. Freddie Mac should not be involved. And there's other people who are applauding it. I honestly, because a listener and a viewer had reached out to me like, hey, Dio, you should talk about this, which is why we're interjecting this into an episode about HELOCs and home equity lending. And that's what the bulk of today's episode is going to be, like the why, the how, the good, the bad, etc. But anyhow, he wanted me to talk about this, and I don't have a take. Like, it's such a small amount. Do we need the GSEs getting involved in home equity lending? I don't know. I can't imagine we do, because there isn't a liquidity problem going on, meaning we're not having an issue with banks and credit unions and lenders not offering the product. Because that's why Fannie and Freddie are around right now, because banks and lenders do not want to offer a 30-year fixed mortgage or a 20-year fixed mortgage if they don't have the ability to sell it to Fannie and Freddie. They don't. That's not the business that they're into. That's not the business model that they want to follow. So Fannie and Freddie have a true need in our ecosystem. Home equity lending, people that are against it are arguing there's not a need. Freddie Mac is raising their hand saying, yes, there is. There are underserved communities and there are rural areas where homeowners in those areas don't have access to banks and credit unions or to lenders the way that people do in maybe larger cities or less impoverished areas. So Freddie Mac is going to roll out this pilot program that says, hey, we are looking to purchase home equity loans or home equity lines of credit. I think they're doing more home equity loans from lenders who want to originate them and follow our guidelines in our pricing models and our pricing structure. And we have been allowed to purchase up to $2.5 billion over the next 18 months. It's a pilot program. And specifically, they're looking to purchase the bulk of these loans that are tied to homes that are in either rural or in underserved markets. So that's kind of like what's going on in the news. And there's definitely some people, and usually these people are the associations that represent banks and credit unions, because like, wait a minute, we were doing just fine serving this community. Why are you going to bring in a government-sponsored entity, aka the taxpayer, to back home equity lending? That's where you hear some scuttlebutt right now. It's such a small amount. Right. It's a pilot program, rural areas, underserved areas, and more specifically, and again, fact check me if I misread this, but more specifically, I think it's only going to be on homes where Freddie Mac already has the first mortgage. So like, John, if you have a mortgage on your house, but your mortgage is with FHA, then your property isn't going to be eligible for this Freddie Mac pilot. If my mortgage is currently backed or purchased or owned by Fannie Mae, then same thing that applies. I won't be able to have access. Now, the good news is there are plenty of banks, credit unions, and lenders who do home equity loans. They do home equity lines of credit.
Right.
So that's the Freddie Mac piece. Okay. Any questions on the Freddie Mac piece? Because I want to move on to really home equity lending as to why the consumer would or would not want to tap into their home's equity, as well as why a loan originator would or would not want to originate this type of product or offer this type of product, and then even give some ideas about some case studies I've done, some real world where home equity lending has changed people's lives. And I want to talk about how it's wrecked people's lives.
Okay, I have a question.
Yes.
So by Freddie Mac jumping in the game, is this going to entice like mortgage companies to offer and create new products that service such a need?
Yeah, I mean, I think that's what Freddie Mac's trying to do. And I think that's why the current association who has been the most vocal against it is it'll create a larger market and more competition. That's the hope. That's the goal. It'll serve more people. Right. It'll make more lenders be willing to jump into the game if they know they can deliver it to Fannie and Freddie. A lot of lenders don't want to jump into the game because it's a second lien. It's a riskier loan. There are people who abuse home equity, and there's people who use home equity because they're in a bad financial spot, which makes the loan that much more risky of it going into default. But like, if I'm running a mortgage company or a bank, I may be a little bit more restrictive with my home equity offerings, but if I can sell it to Fannie and Freddie, wait a minute. I have a buyer and the buyer's the government, okay, I'm going to be more willing to offer that. Well, as supply and demand works, as more people get into the game and there's more companies chasing those opportunities, well, the consumer's going to win, right? Because you're going to get more favorable terms. You're going to get more relaxed underwriting. You're going to get better interest rates. So, yes, there's definitely some people who wouldn't be all about this, quote unquote, extra lending capability because Freddie's going to be purchasing it. But then there's others, and what they're arguing is, well, is it really on the American taxpayer to back people tapping into the home equity? Or should we let the private market dictate that? And there's a really cool Lending Tree article that I read recently where it broke down the 3 most popular reasons why someone would tap into their home's equity. And by the way, before we get into that, there are other ways to tap into your home's equity without selling your house. Like, obviously, sell your house and all that equity is yours. The problem is you ain't got no place to live unless you own multiple homes or you're moving in with your mom in her basement, right? But if you want to tap into your equity, sell your house. I once gave someone advice. That was my financial advice to them. Sell your damn house.
Get out of debt, sell your house.
Sell your house. Yep. And then the other way, you can do what's called a cash out refinance. Right, that's where I'm like, hey, John, you currently have a mortgage. You owe $200,000 on it. Your house is worth $400,000. Let me give you a new loan for $300,000, and you'll get the difference between what it is to pay off what the new loan is, and now you have a brand new loan. The problem right now is a lot of people are locked in to 2.75, 3.75, or even 4.25 interest rates. And interest rates right now, even though they're going down, they're still high 6s, low 7s, depending on credit and qualifications. So it's hard to stomach going from 3.5 to 6.5. But what you can do is say, well, how much money do you need? Let's keep your first mortgage intact, and then let's go out and help you get a second mortgage. So that is the third way to tap in your equity. The first way, sell your damn house. The second way, do what's called a cash out refinance. It's a brand new loan. We pay off your current loan, and we give you a new loan. We give you a new loan for more than what you owe. The difference between what you owe and the new loan is what you get back to you a couple days after closing. Or you can just go do a home equity loan or a home equity line of credit. So why people would do it, the number one reason, according to this Lending Tree article, and quite honestly my experience as a lender over the past 20 years, home improvements. Home improvements, right? That bathroom remodel, those floors need to be redone. You need a new roof. Your AC's going. You want to remodel the kitchen. You want to put new carpet in upstairs. Wherever the case may be, you just got a nasty gram from the HOA. True story. And your house needs to be repainted. Your driveway needs to be pressure washed and resealed. And they want you to resod half your yard, right? You're getting those types of notices. You're like, yeah, but I'm broke as a joke. Okay, but do you have good credit? Do you have a job? Can you afford the payment? Maybe you can tap into your home's equity. Okay, so that's number one, is on like home remodels. Other home remodels would be like, yo, I really want to add 1,000 square feet, do an addition, right? That's another like type of home repair, home improvement. The second most popular reason people will tap into their home equity is debt consolidation. I have lived that, and it was freaking amazing. It was a game changer for my wife and I early in our 20s, right? Like newlyweds, bought our first house, had our first baby. I had done a career change, 100% commission. I was broke as a joke for 2 years trying to make it happen as a mortgage loan originator, because it takes at least 2, if not 3 years to build your book of business. And we are able to leverage a home equity loan to pay off her car, pay off my car, pay off a credit card that we owed $10,000 on, and put 6 months in reserve so we would never go in credit card debt again. And although it took a $50,000 home equity line of credit to do so, my payment on the home equity line of credit was something like $400 a month. My payment on those 2 car payments and on that credit card combined were over $1,200. That $800 a month was life-changing for me. And it was a house I was ultimately going to sell in 2 or 3 years. So it's like I had the equity, I tapped into it. Total reset, game changer. I have 6 months reserve. I have no credit card debt. I own 2 vehicles free and clear. And I'm $800 lower in terms of my monthly nut. I'm talking we slept better. We got along better. I did the same exact thing for a buddy of mine. We used his home's equity because he too went out on his own. Struggled for 5 years for him. Now today he's killing it. Like killing. I'm talking like every year his business goes up by $100,000 in revenue, and his revenue is his income. He's crushing it. But in that 5-year period of him building it, no, I mean, he was traveling from here to New Orleans, from here to New York, from here out to Austin. He went 1099. He had to pay a lot more in taxes, a lot more in benefits, and he wasn't bringing in the revenue that he was bringing in when he worked for somebody else. So, he went about 80, 90 grand in the hole, right? Between car payments, credit cards, whatever he had to do to build that business. But he had bought a home for 130 grand back in 2011. And by 2018, that home was worth 390 grand. Dude, we tapped into that home equity and cleared the cap table for him, hit the reset button, and changed his life. So the debt consolidation aspect is a huge component. And then the third reason why someone would do so is for an investment. And I've helped dozens of people throughout my career do this. Literally, it's like, wait, John, you want to buy that beach condo? You want to buy that lake house?
Both.
You want to buy that investment property?
All of it.
All of the above, right? Hey, John, you want to start a business? Okay. Dude, you owe 100 grand on a home that's worth 400.
Yeah.
I can help you tap into that money so that you can raise the money to go buy 4 investment properties. You can start your business and buy the beach condo, right? Whatever the case may be, by leveraging your home's equity, which is your money, your wealth, into other aspects. When I'm helping someone purchase 3 investment properties because they tapped into their home's equity, please know all we're doing is transferring equity from one property to the next. You went from having 250 grand of equity into your current home. Let's say we took 150 grand out so you could put $50,000 down on investment property 1, 2, and 3. Well, that 150 grand that we took out of your home, you still have $150,000 of equity. It just now sits in rental property 1, rental property 2, and rental property 3. So we have done that throughout the years, and according to LendingTree, that was the third reason. Now, if you want to talk about what's bad about home equity lending,
My favorite part.
Okay, well, because people are derelicts by nature, John. People are derelicts by nature, and we are selfish by nature. Starting with me, I'm probably one of the most selfish people that you could come across. I don't say that to brag. I say that because I understand my faults and my flaws, and I work on that.
Yeah.
But I think it's difficult for most of us not to be self-centered to a certain degree. And we love us some us. We love me some me.
Retail therapy is great. That's why they call it therapy.
Yep. So there's a lot of times that people tap into their home's equity.
Most times.
And they treat it like an ATM.
That's what I would do.
They can't afford that boat, but they're going to buy it anyhow.
But now.
Yeah, not realizing it costs money to actually gas up the boat, store the boat, trailer the boat, maintenance the boat. And every time you go boating, it's money on beer and food and everything else, right?
Oh, wow. I didn't factor that in.
No, not one bit. Not one bit, but they wanted the boat. People tap into it because they want to take that Disney cruise. They can't afford the Disney cruise, but they're going to hit their home equity line of credit because it's like they can't wait until they can save enough money.
Yeah.
They're not willing to go get the side hustle or ask their employer for a raise or work a little bit harder on that 100% commission sales job so they can earn the money so they can afford it.
I have commas in my checking account right now, Dustin. Why would I wait?
You have commas or comments?
Commas.
You probably have comments.
Shit.
Your comments are overdraft.
I don't have commas. I have decimal points, Dustin. I have fucking decimal points in my bank account.
In non-sufficient funds. Yeah. You see comments, NSF.
Wells Fargo hits me up daily, Mr. Coleman.
Yes. Okay. Well, if you have commas, good for you for having commas. Hopefully you have multiple commas. How about that, JC?
No.
But there was a time, especially in that 06, 07 leading up to 08 time period, people were straight up using their houses as ATM machines, and the lending world allowed it. Mm-hmm. The good news is today, the lending world doesn't really allow it. We have much stricter requirements for qualifying. We have much lower either loan to values or what's called a combined loan to value. How much do you owe on your first? Mm-hmm. How much are you going to owe on your second? Add those two together, divide it by what your home is worth. Is that 80, 85, or 90%? So we typically aren't lending to 100% of someone's home's value the way we were. I mean, back in 04,
really?
05, 06.
100% of your value?
Straight up.
Okay,
up.
so
and back in the day, I could have received $50,000 without even an underwrite. It was like, sign here. Let's drive past your house to make sure it hasn't burnt down. we'll do a automated valuation. And as long as the loan amount was less than $50,000, they weren't even going to ask me to document my income or my assets.
Wait a minute. So if my house was for 500, I could take a little loan out for all of it, go blow it all, and then you guys would just come repossess my house.
Yes, but you have to qualify. You have to qualify.
Keyword, always about that qualify.
Yeah, so we still have to prove to ourselves and our stakeholders that you're going to be able to pay us back. So if you don't have a job, if you don't have a good history of paying people back, you're probably not going to get the loan.
Damn it.
But if you can show that you have paid people back on time because you have good credit, and you can show that you have income to support the payment, then yes, I can't see a reason why you're not going to be able to qualify for that home equity, either line of credit or home equity loan. I don't have a preference. I think the preference is personal.
Right.
I think a really good mortgage loan originator could walk someone through why a HE loan might make more sense than a HELOC. Sometimes it's like, you don't qualify for the HELOC, but you qualify for the HE loan. Therefore, the decision was made for you. I mean, but then there's other times where it's like, no, you qualify for both. Here are the benefits of a HE loan. Here are the benefits of a HELOC. Which would you prefer? I would do a HELOC if I truly was going to use it the way you would a line of credit, which is I charge it up, but then I get a big cash windfall and I pay it down. I charge it up, I get a big cash windfall and I pay it down. People can do that are at higher income brackets, people who are self-employed, or maybe the bulk of their money comes in quarterly bonuses. So maybe they want to use the money, but then when they get that quarterly bonus, they're going to pay it off. Use the money, they're going to get that big fat commission check, they're going to pay it off. Other people more conservative, like, nope, I need to know that my payment's $600 a month. I used this $30,000 to remodel my kitchen, remodel my kid's bathroom, and fix all my HOA violations, and I can afford $600 a month, and I need to know that in 10 years it's going to be paid off. That would be the difference. But why people wouldn't like it, why it would be dangerous, and why sometimes home equity lending gets a bad rap has everything to do with the abuse that the consumer. And by the way, the lending and the regulatory environment, right? Like everybody has blood in their hands if you go back 20 years to that time period, whether it was Wall Street, whether it was the rating agencies, whether it was the regulators, the banks, the realtors, the lenders, the consumer. Nobody came out of that unscathed. Everybody had blood on their hands or fault, blame to accept. But the issue would have been the abuse. I don't promote home equity lending so people can go and live a lavish lifestyle. That's my word, derelict. It's not responsible. But I do promote it for home repairs. I 100% promote it for debt consolidation. Because the deal with debt consolidation is like, you screwed up once. Don't screw up again. Let me help you hit a reset button. Let me teach you how to budget. Let me teach you about having reserves. And then, you made your mistake. That's all well and good. What you didn't make a mistake on is you at least bought a house. Let's use that home as equity to get you in a better position. And that's usually life-changing. We're typically taking people who were paying, let's just say all in their bills were $6,000 a month.
Jesus Christ.
I'm just throwing it out there. And now all of a sudden all in their bills are $4,500. That's life-changing.
Yeah.
Especially if it's now that $4,500, $500 a month is going to their kids' college savings. $500 a month is going to a individual retirement account, and $500 is going to that Disney vacation they've always wanted. Because maybe they could afford $600 a month, or $6,000 a month, but that was living paycheck to paycheck. We did a debt consolidation loan utilizing their home's equity, and now all of a sudden their total bills, their total lifestyle is $6,000, but we freed up $1,500. $500 college savings plan. That wasn't happening before. $500 individual retirement account. That wasn't happening before. $500 to the Disney cruise. They can now afford it. They're now going to take it. So that changed their life. Their kids' education's getting taken care of. Their retirement's getting taken care of. And they're making memories with their family. I've always loved the home equity lending for that reason. And then the third reason is one of my favorites too, which is for investment purposes. So then loan officers quickly, and then we'll find a way to wrap this up.
Good for you.
Loan officers quickly, to me, there's no reason to not offer this product. There isn't. Even if you got commissioned $0, $0.
Wow.
And by the way, shout out to Jeremy Forcier, because I heard him say this emphatically. And Jeremy is one of the top originators in the entire country and someone that I love to follow. And he was doing something with our buddy Dave Savage over at Mortgage Coach.
Shout out Dave
and
Savage.
and I heard Jeremy tell the audience, he's like, hey, last year, I'm going to butcher this, Jeremy, but last year I bet I did 17 home equity loans where I made 0 commission. Or I recommended a home equity loan and they didn't choose my product. They went to their bank because it was the right thing for my client. But more importantly, because I'm their lender for life. I'm their advisor for life. They need to come to me for the best advice. And if it's my product, great. And if I get paid on that product, even better. But if it's not my product, or it's a product I can offer, but I don't get compensated by offering it, I still don't care, because I need that client coming back to me every year like clockwork, asking for me to review their current financial situation, review their home's equity, review their current financing solution, and offer them suggestions for how they can better and better their situation or improve their life. I know eventually it will be doing a loan that I get compensated on. Mm-hmm. I know eventually, as rates come down, Jeremy's going to take that HELOC or that HE loan, and he's going to take the first mortgage, he's going to add it together, and he's going to do a brand new loan that pays off both the first and the second. And now the borrower only has one loan again, and maybe that's all wrapped up at a 5.5% rate. Instead, they are at 4% on their first mortgage. They are at 8 or 9% on their second mortgage. That's kind of what home equity lending interest rates are. They're somewhere as low as probably 6% and as high as probably 12% right now, based on what the SOFR and based on what Prime's doing. And based on people's qualifications, their combined loan to value, their credit score, like tons of factors. But nonetheless, like we as loan officers and mortgage companies and loan originators and mortgage brokers, we need to be offering this product and talking about this product and sharing with people this podcast on the why and the why not, the good, the bad, the ugly, the dirty, so that folks know this is a possible solution for them and you can help them. Mm-hmm. So loan officers, mortgage companies, lending professionals, make sure you're educating your past clients, you're educating your circle of influence, you're educating the communities that you serve, so that they know these products are around, they know how to leverage them appropriately, and you need to be the source of information. You need to help facilitate the transaction, regardless if you get compensated today, because I promise you, 2 years, 3 years, 5 years down the road, that person won't forget what you did to change their life, and they're going to come back to you the next time that they need something similar, and the next time could be your time to pick up that $3,000, $5,000, or $7,000 commission check.
Well said, Dustin.
On that note, ladies and gentlemen, boys and girls, if you have questions, like, look, my first name's Dustin, my last name is Owen. I'm very easy to reach on LinkedIn. Like, ask the 2 people that I was chatting with on Saturday while I was eating my brunch, because that's what I did on my Saturday. Instagram is a great way to talk to me and the team at the Loan Officer Podcast. Drop us a line if you need help finding a competent mortgage professional because you have questions regarding HE loans or HELOCs. We would love to be your source of information. And more importantly, if you're a mortgage loan originator and you want more, like you love this, but you want business coaching and sales training, we have an entire community that we built out a year ago. It's really starting to take off and blow up. It's called the TLOP MLO coaching community. It's the best value in the industry in terms of bang for buck. Check it out. All the information is at tloponline.com. While you're on tloponline.com, make sure you subscribe to our newsletter or sign up for our newsletter. It's free. I write that shit every single week. It goes out on Thursdays. And if you're listening to us on Spotify or Apple or anywhere else, thank you. But check out our YouTube channel. It's the TLOP, the Loan Officer Podcast YouTube channel. We have additional training videos and content, shorter, more bite-sized versions of what we do on the show over on the YouTube channel. Make sure you subscribe to that as well. He's John Coleman. I'm Dustin Owen. That's all the time we have for you today, but we do look forward to catching you on the next episode.